All right. I don't know if you guys can hear me, anybody out there, but we're in a power outage here. We got no power, so I'm running on battery backup right now just to start the class and let you guys know that we're probably not going to have class today. So I don't know if you can even hear me. The system said that it was making noise, but I can't hear anything, and all the lights are out. Studio's dead in here. The only thing I got is the battery backup on my laptop. So we're shooting in the dark right here. I'm not sure if I can even share a screen. If I share a screen, it'll be the screen that this whole system's on. So that's not going to work for us. I could try. Let's see if we can at least even just pull up. Let's just even see if we can pull up my UBI portfolio and do a little review of that quick. I'm not sure if I can even do that. Let's see. We're going to give this a try. Not much we can do today. We have a real short class. There's no electricity. So we're in a power outage. They're having fires here in our fair area, not in the town, but that's why we're having power outage. Let's see real quick. Just for fun, we'll see if we can get something to work here. Thought you lost me, huh? Well, that day may come one day, but today we're going to give it a shot here. We're still here. I'm still here. It's just the power's out. Power's out today. So let's see. We should be able to at least look at my portfolio. All right. So let's at least kind of review what's going on with the portfolio. This is the real money portfolio. It's my account, and you can see up here we started with $476,000 back in July of 2024. So you see each one of these little squares right here. This is representing each one of our yield max funds that's in this portfolio. So this is my yield max funds portfolio. So that's what's happening. Each one of these boxes represents a different yield max fund. And as we come across here, you can see that this is Palantir. Palantir is probably doing pretty well for me. It's doing probably my best one. And this little line across here is telling me that that was my 2024, messing it up, 2024 investment. So I started with 5,200 in 2024 in Palantir, but that was right in December. So pretty much this is all of just this year. Palantir's gone straight up. So we've got $141,000 in Palantir, where I can't even see that. It's too small. $56,000 over parity. So this is all the money that it's given me, plus it's risen in value. So it's doing pretty well. So it's given me $41,000 in dividends this year. And current value, it's $155,000. So it's over parity. So that means the total infusion 141 is what we put in, and it's paid me back 41,000 so far this year. That's pretty good return on your money. If we come up here, we can see the Palantir line, and Palantir is right here. So there's Palantir, and you go across, you can see right there. What we've got is we've got monthly average. It's been paying me $6,850 a month. $6,850 a month on average on a $141 investment. So if you have $150,000 and you can put it into Palantir, well, over past performance is not necessarily indicative of future results, but it's paid me about $6,000 a month in dividends. That's pretty good. A lot of guys could retire on that. So $6,000 a month on $150,000, $141,000. And then this one here, this is Misty, and I've got $182,000 in there. So you can see $182,000 in there, and it's been giving me, Misty gives me on average $9,000. So $9,000 on $182,000. So it's a little bit more than what I've got in Palantir. Palantir, I've got $141,000. Misty, I've got $182,000. And Misty gives me on average about $9,300 a month. And that's less than $200,000. So if you could get $200,000, you could retire. I think most people could retire on $9,000 a month. And then this is my third one. I got Snowy, and I've got $51,000 in Snowy. And Snowy has given me on average, you can see right here, draw that over there. With $51,000 in Snowy, it's given me on average $2,650 a month. So that's a pretty good one for me. NVIDIA, I've got 65,000 in there. And I started, the thing is that you get blended money. All right. The problem with this is you get blended money. So I actually only started with 42,000. I just reinvested. So I'm compounding my money, right? Compounding. So when I get money, I put more money in. Now I don't take it just from NVIDIA. I've got my whole portfolio. So if I get some from Palantir, I might put it into NVIDIA. Or if I get some from NVIDIA, I might put it into Palantir. So I got mixed money. So I try to do just with what I started with. And so I started in 2024 in NVIDIA with 42,000. So that was kind of like fresh money that I, went to McDonald's and worked and got that McDonald's money and put it in here, 42,000. And then the rest of it, it's all blended money. So I didn't really have to go work for that. It was given to me for free and I put it in there anyway. And then this is 65. So I've got $65,000 in there, but I started with 42,000. That's another thing you have to keep in mind. Even here with Misty, I started with 130,000, and with Palantir, I started with 5,000. I only started with $5,000 in Palantir. And then this was free money. This is money that came from other dividends that I'd received over time and put into this one. You can see I put $69,000 in March, $46,000 in April, and $19,000 in June. That's what brought me back up to the 141,000. But this money right here was all from other dividends that had been given to me. So it's blended money. It's not like I went out and worked at McDonald's and made 69,000 and put in there. No, this is compounded income. It's compounded. So I mean, that's pretty cool, right? So I started with 5,200. I'm up to 141,000, but all that money was from other dividends. I didn't put that in from McDonald's money. And I'm already making, on Palantir, you see from all that blended money, $6,000 a month. So that's pretty cool. So all this is blended money. When I come in here and say, well, my total infusion against the parity, I'm $7,000 against total infusion, not $7,000 against just the amount of money I put in there. So for example, on this one, NVIDIA, I put $42,000 in 2024. Now, the thing is part of that was blended money too. I started with 476,000. Now that was my money. I went and earned that. Worked at McDonald's, not actually worked at McDonald's. I worked at my business, right? And that was just savings that I had, and I put that money in there. And so I had $476,000 that I felt like felt comfortable putting into this Yield Max project. I wanted $500,000. That was my goal. So let's put $500,000. But I have a traditional IRA, which you can see over here on my second spreadsheet, and it had 172,000. So I started that one in there too. Oh, I think we got electricity. How about that? We're back in business. All right. I think we might be in business here, guys. Power's back on. We get some lights. Turn the studio lights on. All right. I think we're back in business. How about that? We got electricity. Electricity. All right. Give me a second to get this all set up again. I think we're back in business. Okay. Let's come in here and see if they'll let me change a few things on the fly. I don't think they're going to let me change this all up. And I can't do all the screen share like this. It's not going to let me. Let me see. I'm going to go out and see if I can leave the meeting and come back in. They let me do that before. I don't know because I can't do anything. I can't change anything on the fly. They're not going to let me. Oh, maybe they will. Oh, maybe they will. Camera. No, that didn't work, did it? Yeah, we got our camera back. All right, we got our camera back. Let's see if we can get our audio back. Okay, we're working on it here. I don't know what this is not giving me. Testing. That worked. I don't know if we're back on them. Is that a better microphone? Can you guys tell if you can hear me better? I think I got the right microphone. All right, testing. That looks better. Okay. I think they let me back in. Except for they're not letting me share my screen. Hmm. Let's see. Let's try this again. Did that work? There it is. Oh my gosh, they're letting me work in real time here. They saw that I was having too much fun, so they cut the electricity. It was the other way around. They gave me the electricity back because I was having so much fun there, Chad. So, all right. So I'm not seeing any screen other than LAN, no chart. Yeah. Oh, so was it screen share? Kirk says the screen share wasn't working. So I was looking at my portfolio and nobody could see it anyway. All right. Well, we're back in business. So let's try and do what we planned we come here to do. Boy, this is throwing me off a little bit. Let's close this out. We were talking about my portfolio. That's all I could get up. Let's see if we can get the software to work now. And we'll go in and check out Bubbles and see what Bubbles is doing. Let's go into the demo. Okay. All right. We're getting back into business here. We got studio lights and everything. All right. Okay, what I want to do is we're just going to go through and see if there's not anything to trade this morning. So let's come in and let's go into Bubbles. And it says out there on the little marquee that we're going to trade with Bubbles. So here's Bubbles. If you go to FinViz is this little tool here on the internet. It has this little heat map here. And if you come over to the heat map, it kind of shows you what's popping today. Microsoft popping pretty hard. It's nice green high color. Amazon's popping. Nvidia, Meta. Of course, Apple's not popping. Why? Because we have Apple. So our covered call's paying off. But other than that, piece of shit, Apple. Oh, now I got to go to YouTube. Apple made me have to go to YouTube Confessional. So let's come down here. Well, we're going to go to Bubbles in here. We're going to go into the Bubbles heat map. See right up in here, it has heat map, then it has Bubbles. So there's Bubbles. And there's Bubbles. There she is. All right, we're going to come in here and we're going to go down to volume. Let's just go volume. And we're going to change this. Well, that's all we need. That's the S&P 500. So let's dump a couple of these that are really flushing hard. So that's ALGN. We're going to get rid of that one. ALGN. We had the Fed came in yesterday and said they're not going to lower interest rates, to the chagrin of Donald Trump. He was not very happy about that. So I don't know. Trump wants that to go down. And if he does, the market will just go nuts. I mean, the market's already going nuts. That's the reason why the Fed won't lower the rate. Because if they lower it, the market's going to go even more nuts. And then that could cause inflation. And that's why they're keeping it up there. So although Donald Trump wants him to lower it, because that would lower, what did he say, $300 billion per year in interest that the U.S. is spending because of interest. So if you lower it one tick, it would $300 billion savings to the U.S. government, because they have borrowed so damn much money, right? So they want it to come down so that they can not have to pay so much money in interest. But if they lower that interest rate, the market's going to go straight up. And what do we always say? When bonds go up, which is what the interest rates are, right? When bonds go up, the stock market goes down. When bonds go down, stock market goes up. And so if they lower the interest rate, that would cause the bonds to go down. The short-term interest rates, the bonds would go down. And let's go look at that right now. Let's see what happened. SHY is the symbol that we watch for that. And you can see it's just going sideways. He didn't lower it, didn't raise it, just left it where it was. And so it's just kind of going sideways. And so we can see that this market is just kind of going through this little wedge pattern right now. It's just kind of hanging out, going sideways. It's not going up. It's not going down. He's just leaving it right where it's at. And so the market's been moving a little bit, but that's not moving much. He didn't move it yesterday. Announced that he wasn't going to lower it. And so it should keep inflation down, though. Not that we have any inflation. I think the inflation was at 2%. So 2.3% or 2.5% or something. So, that's right where the Fed likes inflation. So they're like, well, it's right where we want it. Why would we change it? Just Trump wants to fire the guy because he's not lowering the rates. But I think Trump's got to realize that if they lower the rates, it could cause inflation. So that's why he's trying to get him to quit, but he doesn't want to fire him. Can he fire him? I don't know if he can. Says he can, but I don't know. So interest rates are staying right where they're at. The markets are pretty quiet at this rate. If we come in here and we look at SPY, just look at the S&P. Oh, well, this is the sectors. Let's get rid of this. Get rid of all of our drawings. These are just the sectors. So this is the energy sector. Let's go look at the tech sector, technology sector. Look at that thing. Wow. That's AI. That's your AI bubble right there. That is one crazy AI bubble. Look, we're only in the second drive. Drive 1, it's the only counter trend we've got. Drive 2, it hasn't broke the counter trend. That's the craziest thing you're going to ever see. That I've never seen anything like that, except for, well, we saw it during the dot-com bubble. We saw the market do this. And then the market kind of did this on the recovery of COVID. It just went straight up. So if we come over and we look at, let's see, healthcare. Healthcare is dead. Look at that. Nobody's sick. Is that what that means? I don't know. This is the consumer discretionary. Discretionary funds, consumer discretionary. That means you can spend it if you want to, right? And look, they're spending a little bit. Not as much as they were. It's not broke all-time highs, but that's your discretionary spending right there. Utilities, even utilities are getting more expensive. That's all that's telling you. That's not any fun. Consumer with technology, there's industrials. Look at the industrials are going nuts. Financials are going nuts. Energy sector, it's on its third drive. It's on drive 3. Drive 1, drive 2, drive 3, and it's trying not to break that high right there. So there's the high, and it didn't break it. You think it's going to break it and go into a fourth drive? Possibly. Don't know if we're going to get much of a pullback on that, but that's where that's at right now. It's just snaking sideways on
on energy. We don't really want that to go up. Well, those are energy companies. So are the energy companies making money? Yeah, they're okay. They're not hurting. And then this is the communications sector. We're looking at that down here. And look at that. We were looking for the third drive right in there. We didn't even get that second pullback. What a nasty market. Nasty good. Woo, look at that thing. There's your, let's get rid of that and just come in here and draw one trend line right up there. One trend line right up there. We got the third drive pattern in there. We got, man, what a crazy market. All right. Kick Jerome Powell out, Chad says. Chad wants him out of there too. I don't know. Too late, Powell. You don't want a Fed. You realize that Donald Trump's the one who put him in there in the first place. All right. He put him in there in his first term. So he was in there and stayed in there the whole time that Biden was in office. So you don't want Trump calls him too late, Powell, but you don't want a Fed chair. You don't want a Fed that's constantly moving things all the time. You actually want a Fed that doesn't do anything. That's the whole idea of the Fed, is to keep things calm when everything else is crazy. The Fed walks on the stage. They're supposed to keep the world calm. That's what their job is, right? You say, well, the Fed, Trump gets on them all the time. Well, they don't do anything. It's the easiest job in the world. They walk in every 3 months and say, well, we're not going to do anything. And then they walk off and don't go do anything. That's what you want a Fed to do. You don't want the Fed to do anything. Because if the Fed's sitting there changing stuff all the time and always messing with the market doesn't know what is going on. It's like, I never know what to expect from this stupid Fed. Are we going to borrow money and try and grow our companies or not? So having a Fed that basically doesn't do anything, and interest rates aren't that bad right now. I mean, everybody complains, but that's the young people who haven't had any experience with markets, haven't had any experience with interest rates. Interest rates are perfect right now. I don't know why we want to change them at all. Just leave them right where they're at. I mean, people who, in fact, it wouldn't hurt them to be up a little bit, because people who live off the interest, these are low interest rates. I mean, you can't live off of 4%, 3.5%. That's all you're getting off of this interest rate. That's a good rate. I want to buy a house, and houses are too expensive. Yes, houses are expensive. You know why? Not so much because the interest rates are high, because the interest rates for houses aren't really all that high. High, yes, from zero, but you can't leave interest rates at zero. That's ridiculous to think that you can do that in this type of an economy. The interest rates, they need to be that happy medium where people who live off of interest rates can make enough money to do so, right? You got to have money. That's why you save money, so you can get interest on it, and you got to make it worthwhile. So it's right there, in my opinion, right at a pretty good balance. People can borrow on it. It's not that expensive. I mean, I paid, my first house was like almost, I think we got it a little over 10.5% or something was what my first house was when I borrowed money. 10.5%. You can go out there and get a house, borrow a house right now for what? 5 or 6%, 7%, 6%, something like that. That's what houses are. My first house was 10. And I was lucky because they just came down from 12. And we thought 10 was a great rate. We were like, wow, it's only 10. We really scored big. I don't know. You need to have interest rates so that people who live off interest and make money off of interest can make money. They're not bad right now. I know everybody wants them to go back to zero. It's not realistic. Right? You don't want a Fed that's jumping in and out and changing the interest rates all the time. They got them set at a really nice rate. Could they be a little lower? Yes, they could be a little lower. All right, look at materials are coming down. All right, let's go back and look at bubbles. We were just wanting to look at the S&P. And you can see the S&P, that's the, look at the S&P, just keeps going. Just keeps going. Drive 1, drive 2, drive 3. Look at that thing. Look at that thing. We're not getting no pullback, but it's not racing either. It's not racing either, which is why you're seeing a lot of our yield max funds are being really slow. So for example, if we go into PLTY is really super high, right? That's PLTY. We want PLTR. PLTR. So see, Palantir is really high. It's gone up into drive 1. This is drive 2, and we're into drive 3. You got kind of that little funky thing happening right here, but that's all one drive. So we're all the way up here on Palantir going into drive 3, and it's the bars are kind of small, but it's going. We're making money, man. I mean, you can't complain about Palantir. It's really good. You can complain about Palantir because what they do. There's surveillance and murder. Well, I don't know. They don't, you know, when the military goes out and kills bad guys, you want to call it murder? I don't know. But the Palantir is really good at that. Surveillance and killing people. That's what they do. They make it easier for the military to spy on people and kill them. So that's what they do. A lot of people don't like Palantir, but I don't know. If you want safe country, but just so long as they don't turn their technology on American people, that's the problem that I'm worried about. You know, the government likes to spy on people. It's just in their nature. It's just in their nature. And so if they use that technology on American people, that's where we're going to run into trouble. All right. But they're really good at it. They're really good at it. All right. So you want our military to be more efficient, and that's what Palantir does. They coordinate airstrikes and military exercises, whether they're live exercises or fake exercises. They coordinate military exercises across agencies. So that's not ever been happened before. I think I mentioned this before. It used to take like 2 weeks for them to coordinate an exercise to go in and bomb somebody against the Navy and the Army and the Air Force and all the different, you know, military organizations that have to call each other on the phone. Hey, we're going to go and we're going to go bomb Iran. You want to join in on that? We're going to need you to, you know, bring some boats in there or something. Navy, can you get some boats in there? That's how they used to coordinate. Now they do it all on computers with AI because of Palantir. So now they can go in and say, we're going to go bomb Iran. And they can coordinate the whole thing all right there with the computers and say the Navy's going to go in here, the Air Force is going to go in here, the Army's going to be over here. And they can coordinate the whole plan on the computer with AI's assistance. That's Palantir. You think they're going to give that up? No. Do you think they want more of that? Absolutely. That's why Palantir's going straight to the moon. That's why their PE ratio, if you come over and look at their PE ratio, I know we're supposed to be doing bubbles, but I get distracted on this fun stuff. Fun stuff, making us money. Look at all the money we're making on Palantir. Do we think it's going to pull back? Probably, but are you worried about it? Not really. Why? Because I think the government wants more of this. So if we get up here into the top of a drive 3, this would be a C1 right here, right? And that would be C2 right there. So we're in a C2 stage right now. We're in C2. So that's C2. And it's been massive run. I mean, just amazing, right? So are we going to cap out up in here and go to a C3? Are we going to get a nice big long extension C3? Is the C3 going to fail? What's going to happen up in there? But we need some sort of, you know, we got money sitting on the sidelines. I do. I got a bunch of money sitting on the sidelines. I'd like to put back into more Palantir. Give me more of that, right? I want more of that. So if we could get Palantir to even come back to, you know, we don't know where it's going to peak out. It's still going up. So I don't think it's going to peak out right there. I think we're going to break that. But eventually it would be nice to see it come back down. If we do a Fibonacci bow tie, right? Bow tie, we could come off of here. This is how you project where it's going to go from here down to here, up over the bow tie to 200%. 200% is right there. That's about as close as I can get it. So if we put that in here, let's watch and see how good of a predictor this bow tie is. And then it would come down to at least this point here. And if Palantir would come back to that point, you could buy some in. We got another bow tie back in this region here. Right? Not a very good one, but this is a point of resistance back in here. So 38.2 is not some place we could look. Man alive, if this thing would come back into 38.2, you know, probably do one of these to get back here. We could load up, we could sell your kids I mean, you sell your house, sell your kids, sell your truck. Don't sell your motorcycle. That's the only thing you can't sell. Don't ever sell your motorcycle. Ask me how I know. It's just so depressing. I mean, your life will go to hell if you sell your motorcycle. Don't sell your motorcycle. Even if you don't ride it, you got to have it out in the garage. So when you walk out in the garage, there's your motorcycle. Haven't ridden that motorcycle for 6 months, but it doesn't matter. It's still there. That is important. All right. Never, ever, unless you buy a new one first. You got to, you can buy a new motorcycle, then you can sell your old motorcycle. But don't ever, ever be without a motorcycle again. If you are, it's like cutting off your left nut. All right. Don't do that. It's bad. Okay. So you lose all of your motivation for life if you don't have a motorcycle. Okay. Let's see. Maybe for you it's golf clubs. All right. Don't ever sell your golf clubs. Even if you don't play anymore, don't sell your golf clubs. All right. Let's go in and see what Bubbles is doing. We've looked enough at some of these Palantir, some of these other markets we're already in. Let's see if there's something new to get into. eBay's on fire. Holy cow. eBay must have had earnings. Let's go look. Should we? eBay earnings. Holy cow. Wait a second. They had a surprise down on the Gap reporting. Who cares about Gap? Let's just look at earnings per share. Look at that. 5.6% revenue, 3.2% increase, $86 million surprise. Wow, look at that. Any of you guys have any eBay? I don't have any eBay. Look at that. You want some at that price? No. It'll probably fluff back. We'll wait for it to kind of do one of those things where it goes up and then you'll have like 6 bars of little tiny pullbacks, make a little flag, and then we can decide if we want some of that. But we should probably put it at least on our watch list because, man, if that company's doing that kind of business, we probably want to be a part of it. Let's wait for it to pull back, though. Oh, that's not the one we want. Let's come back. Oh, we got to come over here. Albert, it's good to see you. Great to have you come in. We had a little power struggle this morning. So we were out. I was just running on battery backup to get the class going, but then the power came back on. So we're trying to get our heads back into what we were doing here. So we need to go back to Bubbles. How do we get back to Bubbles? There we go. All right. So eBay, Meta. Oh, wow. Meta. We have Meta, right? We have Meta. There's NC. Norwegian Cruise Lines. Now, we were looking at Norwegian Cruise Lines at one point. Did any of you pick it up at that point? Look at Robinson Worldwide, whatever the heck that is. This is just the S&P 500, too. We haven't gone into the little guys. Microsoft. Holy cow. Now, we have some Microsoft. We have a bunch of Microsoft. Now, you might have it in, look at this, NVIDIA. Everything is green. Intel. So Intel's having sad days. I'm really disappointed in Intel. NVIDIA come and just took their thunder. That's a company. That's a company you didn't think would ever be knocked off their pedestal. And sure enough, they cannot get their shit together. Look at all these companies over here fluffing now. Let's go see which ones are climbing. We don't care about losers. We don't like losers, right? Okay. RSN. We don't know what that one is. Hewlett Packard. Hewlett Packard had a big gap up. They're at $21. Cisco. Wow. I want to go see Cisco. Let's go look at Cisco. One, two. Oh, breaking highs. I hate that. Doggone it. I would really like to have some Cisco. Cisco is the, all these guys that are Meta, OpenAI, Google, I think, of course, and then Elon Musk with with Grok. So all these big AI companies are building these massive computer systems, right? These big data centers. And these big data centers, they're massive. I mean, I saw Zuckerberg's footprint, and they had Manhattan, the island of Manhattan, right? New York City. And Zuckerberg's data center laid over the top of Manhattan took up the entire island. That's how big his data center is. You've heard that he's been trying to hire people away. He's paying people half at $500 million to come and work for him in the AI industry. 500 million. He's got a guy on there. Now it's not 500 a year. It's like your contract is to come and do this for $500 million. But he's got a couple guys he's given $100 million to. A couple guys he's given $500 million to come and run his AI data center. He stole them away from other companies, right? Some of the founders of some of these other companies. And so he stole them away, paying him that kind of money. And then he's just unreal amount of money going into this stuff. And most of it he's given away for free. I mean, Zuckerberg's stuff is all open source. But he thinks that in the future, if you're using his open source stuff, you'll be able to charge you for it and make his money back. But can you imagine? I mean, just billions and billions of dollars. And Cisco is the company that builds all those data centers. They're the ones who come in and build those data centers. So this would be a great company to own if you think that this AI stuff is going to continue to expand. So that's where we're sitting right now. This is the third drive. Drive 1, drive 2, drive 3. That's the C. But look, it's kind of, let's go back over to the trading platform. There's got to be an opportunity to make some money here. Let's see. I don't want this in here. Where's our portfolio? Lands active. I think let's just call one, just do a new one. You see, I cleaned out all my portfolios. We'll just call this bubbles. And we're going to come in here and look at CSCO. There's got to be an opportunity to make money in here. The thing is, we got to be cautious. We got to be careful. Why? Because that's a C drive, right? So that's a C1 right there. And it's being lazy. Little C1's kind of What could we do? You know what we could do? We could come in here, go 15 days, and we could sell a put. We could sell a put right at the money. Oh, that's not very much money. It's only $173. We want a little $132 if we do it just one click in the money. Let's go look at options. Oh, it's got plenty. The spread is it's not the tightest, but it's okay. Right there. That's one everybody's trading. Up there, we don't want that one. We go here. I'd rather have one down here. Oh, this one here. Premium. Oh, those are calls. Land, get off the calls. We want to do puts. So we're going to come in here and we got to do puts. And oh, they're right there. 66 of them today, 114. That's the ones they're doing. 114. So we could come in here and then where would we buy our put? We'd buy one down here. Maybe a little bit, maybe like that. That'd be a 28% return on your money. If we go up tighter, that's 28%. It's still 28, 28, 28, 28. Let's go down here. That'd be a 24. Let's go right there. 28% return on our money. That'd be $43. Margin requirement's $150. Spread is $7. Ooh, the spread for I think you could get a spread of $7 in the real money account. In the demo, they're not going to give it to you. So we would have to go down to 36 in the demo, which is $13, 36. Or you're going to have to give it up in spread, $14 in spread. But I think if you go do this in the real money account, you could get it at in the midpoint. Maybe. I don't know. There's not that much volume today. But you got this little pop. So we're not getting, you might want to wait and do this tomorrow, but tomorrow might have another green day. Wait and do it towards the afternoon, and when implied volatility calms down, maybe the spread will tighten a little bit. You know, you're talking a couple bucks. I don't know. Yeah, just do it when you want to. So we're going to come in here and let's put in, let's say 5 of them and see what 5 does. If we put 5 of them in, that would be 28% return on a $750 investment. They're going to margin you at max loss. So let's risk $1,000. So that's 7 of them. That's a 28% return on your money, which would be $300. So a 28% return on your money in 15 days. That's unreal money. That's just like, who makes that kind of money? That's like, holy smoly. And all it has to do is just stay above the red line. Has to hit, that's the carnival game. All right, we're setting up a carnival game here. So the carnival game for this is that we're going to make 28.6%, 28.6 times 24, 686% return on our money, annualized. Who makes 686% return on their money annualized? That's a lot of money. How many of you will agree that that is a lot of money? Raise your hand. 686% return. All right. So we can't complain about that. Our risk is $1,000 though. We could lose $1,000. How would we lose $1,000? If it hits the purple line under the red line. If it does that, that's where you'll lose your $1,000. Jay says he's in for 600% return on his money, 686% return on his money. I'll have me some of that. All right. All you have to do to make that kind of money is put this order in there just like this and have that market not close below the red line. It doesn't matter where it closes, anywhere on that purple line. It's just got to touch the purple line above the red line. That's your carnival game. I tell you, this is a carnival game. All right. What are the odds of that happening? Well, we can come in here and look. Right now, it's just a little bit below. So you've got an odds of that being out of the money. You got, that would be the opposite of this. Probability of being out of the money. You got a 66% chance that that's going to happen. So that's better than black and red, 66% chance. Plus we're at a C1. Plus we got a little rally bar here. Plus we got an explosive market behind us. We got everything saying that there's the chance this could go into a nice C1 drive and stay above that red line. That's the whole game. You walked up to the tent on the fairway at the carnival game and they said, do you think the snake is going to stay above the red line and hit the purple line, or do you think the snake is going to fall below the red line? If it falls below the red line, you lose $1,000. If it stays above a red line, you make $300. That's your risk. It's a reverse 2-to-1 risk reverse. It's about a 3-to-1, 369. It's a 3-to-1. It's a 1-to-3 risk. It's a 3-to-1 risk versus reward ratio. You're going to risk 3 to make 1. But the odds are in your favor that it's going to do it. 66% chance it's going to stay above there. Are you going to do it? I'm going to do it with 7. Hell yeah, I'm going to do it. Yeah, I'm going to do it. 36. Oh, it just went to 29. Ugh. Remember, I think you'll be able to get oh, look at the spread on that, $126. Oh, that's for 7 of them. But that's going to take away. Now we're only going to make 19% return on our money because the spread just widened on us. You got to watch the spread a little bit. It changes things. So now we're at 19.33 times 24. Now we're only at 463% return. Jay, you still in? It went from 600 to 463 just in that few minutes that we were sitting here. Because it stopped. I mean, it probably rallied some more. That's probably why, because it went down. All right, it's moving in your favor. All right, place your order. We got those. We're in there. We'll have to wait and see. Now we just got to see it stay above. Just got to stay above that red line. That's all it's got to do. Just don't fall below the red line, Cisco. 1 in the hand, 2 in the bush. If you'd abide the call, well, then the market would have to rally. Let's say we spent $300. The market would have to rally $300. That would be up here. That means it would have to go up there just to break even. So what do you want to do? You want to say, well, I think the market's going to go up there above this line, or which is easier for you? Anything above that line, you make more money. right? You get your $300 back, plus you get whatever profit. See, it's harder to trade calls because now you're saying, well, to make any money, to make the same amount of money, the $300, the market would have to go up there at expiration. It would have to be right there for you to make $300 if you bought a call, because you'd have to pay $300 and then you have to make $300 to get your money back. Just to break even is $300. So I'll take that premium on my side for anybody who wants to buy the calls right there. All right, and then I get the one in the hand. Of course, it's got to stay above the red line. Doesn't stay above the red line, I lose. That's the game you're playing. That's the carnival game. That's why I call it a carnival game. I don't call it gambling. Gambling is luck, pure luck. This is carnival game. This has skill, a little bit. Oh, gambling requires skill too, Lan. Yes, it does. But you've always got the same odds. You're always working with the different odds. See, at least this way we got better odds. We got odds in our favor. 65% odds that it's going to work in our favor. All right, let's go look at a different one. That was Cisco. Let's see. Let's go back over to Bubbles. Where did Bubbles go? She ran away. Come on, Bubbles. Now I got to set everything up again. That's real hard. Change it to volume. Oh, and we lost our ALGN and BAX. All right. Did we go look at eBay? We did. We don't want any of that. Meta took off like a rocket ship. We missed that unless you already have it. Norwegian took off. We missed that unless you already have it. What's something else that could take off for us? Oh, Ford Motor Company. Look at that. Oh, wow. Let's go look at Ford. Woohoo, look at Ford. All right. We were all looking at Ford when it was taking off up here saying, wish we had me some Ford, right? I wish I could get me some Ford. And then Ford pulled back into this range here, and everybody's like, oh, I'm not buying me any Ford. I didn't think Ford would go back up after that. And then it did. And now it's like this, and you're like, oh, I'm not going to buy me any Ford. It'll never go back up after that. Right? Right? I know what's going through your mind. I've been there. This is good pullback. This is drive 1 right here. Drive 1 and Ford. This is your counter trend. This is drive 2 and Ford. We're going into a C drive. You want to get heavy into a C drive? Maybe you don't want to be heavy into the C drive, but we're getting this little ABC pattern in here coming back, right? This is what do you see in there? I know you guys are seeing it. You're like, oh my gosh, Lan, look at that perfect little Fibonacci bow tie. Fibonacci bow tie. Right back to 130.9. There's our bow tie off right there. Look at that. It came right back to the bow tie. Just like a train on rails. All right. What are we going to do? Well, the blue light's down there. How far back do we think it pulled down? It's already pulling back. If we go into a shorter term time frame, let's go a 5-minute chart. So it dropped hard, and now it's already pulling back. Already, look at how much this thing's already taken back off. So that was our 5 o'clock. Oh, that was 2 p.m. yesterday. Where's our 5 o'clock bell? Right here, 5 o'clock. And now it's taken off. How about that? Ooh, yeah, baby. How much Ford do you want? Should we back the truck up? Metaphorically speaking, no pun intended. Should we back the truck up and buy some Ford Motor Company? How about that? That's on our 2-minute. That's our 5-minute chart. That thing just took off like a rocket ship right out of the gate. 7:30 this morning. Wow, look at that. That's nice. Doesn't mean it can't come down again, but we missed the 130.9 right at the Fibonacci bow tie right now. It's just rebounding. How would you take advantage of this market? Well, you could do the same thing. There's several things you could do here. We can do a Fibonacci projection off of the second drive, right? And now we're anticipating if we put our Fibonacci ruler on there, that thing came right back down, just like, say it for me, Chad, say it for me. Look at that. It came down and hit that 61.8 as if a computer did it, as if Aladdin did it, as if we had reverse engineered the magic computer systems. Train on rails. Jay said it for you. Jay beat you to the punch, Chad. All right, here we go. Man alive, look at this. Craziness. I think we should get in on this. How are we going to get in on this? We could do the same thing. We love those little, you know what? If you're a little bit more aggressive, watch this cool trick. Watch this cool trick. Because if we come in here and we say, all right, we're going to go in with the 100% right there. If we're going to go in and say that's where we expect this market to go, Fibonacci all the way from low all the way up to 100%, we got some upside potential on Ford making a third drive on this thing. Do you think Ford's going to make a 3-drive pattern? I do. I think it will. If I think it's going to go to 100%, it'd be nice if it go to 130.9, but we'll say 100. All right. That's just the same distance it went last time. It went from this low to this high. So right now we're this low. We don't think it's going to go any lower because it hit the 61.8. Doesn't mean it can't. Certainly can. It can come down. There's another number hiding down there, right? I got it turned off. But that's 78.6 in there or something like that. Let's go see. Fibonacci 78.6 right there. So there is another number hiding in there. All right. That's the longer term one. We're going to turn that one back off. Fib line no there. Yes, here. I got to send that to the back. Send to back. Here we go. Now we come in here. This next fib line, 78.6. It could come down to here, right? It could just keep coming down, come all the way down to here before it rallies. If it does that, well, we'll be in trouble, won't we? Now, we don't have to be in trouble if we think it's going to come down there. Thing is, I don't think it is. I don't think it's going to come down there. I think we got a strong market. I think we got Ford's doing well. Let's go see. Should we go see how well Ford is doing? Ford. Some of you guys have subscription services to these guys, so you see these numbers. Some of you don't. So we'll show you the guys who don't have subscription. You can just look off mine. Right here, earnings per share, 146. That's pretty good. That's 2024 did 146. Where's they at right now? Upgrade. Wolfie. Peer perform, underperform. They didn't set a target though, but they upgraded them. That's April. This was downgrade April 10th. Oh, that's April. That's old. We haven't got any upgrades or downgrade there. This ought to. Come on, guys. Come on. Give us an upgrade. That'll make Ford go up. So we got 146. Where is it now? Dividends. Look, these guys even give you dividends. They're why bother dividends, but they're still dividends nonetheless. PE ratio, 8.86. What? No way. Are you kidding me? Are you kidding me? Look at that. Their PE ratio is 8.86. It was 1.46 last year. Look at their sales. Sales in billions. 2024, they were 184. Where's their sales right now? 182. They're at 182 right now. Last year, they did 184, and we're still got like 4 months left in the year. Ford is making money. Hand over fist. All right. Well, you might want you some Ford. I want me some Ford. Okay, look at this. They're trading at $11 a share right now. They've been as high as 12. If we get a Fibonacci bow tie on this, they'll come up to 100 and then pull back to 12 again. So 12 is kind of the magic number. What did those guys? Those guys didn't give a They didn't give a projection, did they? Last time we had a projection was 10, and that was in April. And it's 11 now. So April, May, they said 10. Well, their projection did pretty good, but they've stayed away from making another prediction. I think we're going to go to a third drive, guys. I think we are. I think we're going to get 3 drives out of Ford. And I think we're going to see Ford at, I'm going to make a call. We'll see Ford at 12. And if it goes this fast, which I don't think it will, probably be a little slower. It might be out here a little ways. 12 by end of September. Let's say 12 by end of September. So if we make a Fibonacci projection, there you go, here and then out to September, into September. That would be where we'd think that cone of probability is going to be. Let's do it like this so it draws a little better. How can I draw that cone of probability? We go here and then out to September. Do you think it'll stay inside that cone, go up that strong? Maybe not. What if it doesn't go quite? Let's just go to the break even 61.8. If we put the Fibonacci, if we put the, well, Gann is saying 2 to 1 is up there. We'll be, I've drawn mine in here at, let's put it mine at 3 to 1. Be a little bit less aggressive. So if we think that that's where this market's going to go, we think it'll stay inside of that cone. All right, if that's what we're going to do, how far out do we need to buy some? I'm going to show you another neat little trick. Let's do another neat little trick. Turn off auto scale. We're going to do the same thing as we did before on Cisco, but we have a bigger guesstimate that the market's going to go more, right? It's going to go all the way out till the end of September. So we're going to give it till the end of September. We want to stay in this market that long. So we're going to come in here. How many days is that? End of September. We come out here and like that. That's 50. So we need at least 50 plus 30. So 75 actual days. So if we come down here, 70, oh, look at that. Perfect. 78. We're going to go 113 because we go to the next one out. So we're going to go 113 days out. Okay, so we have 78, and then the next one out, give us a little buffer because we think it's going to take about 78 days to get out there. So we'll go 113. So we're going to use the 113 options. Okay, that's how we decide how long we buy, how much time we buy. Now we're going to come in here, and we're going to come in and we're going to sell. We're going to sell a 113 put. Watch this neat little trick. We're going to sell a put, and we're going to put this right at, ooh, we're going to have to do it right there. I don't want to do it way down there. We could, but I don't want to. Do it right there. There's no money in it. Okay, we're going to sell that one. We're going to also, that means we're going to have to buy one. So we don't have to. We don't have to, but we're going to. We're going to come in here, we're going to buy one now. So now we're going to buy one down here, and we have to go just the next click. It's right there. That's the only choice we've got. So that's 41% return on your money. That's if we just do the same thing we did last time, and you're going to have to wait 100 days to get that $79. Are you in for that? No, nobody wants to do that. To make 41% on your money, wait 113 days. That's not bad. But we want to do better. So now we're going to come in, we're going to buy a call. And we're going to buy the call right exactly the same price we sold the put. Boom, just like that. Okay, that's called a, this is called a, what the heck is this called? This is called, oh, you know what? This is called a synthetic long with a covered put. So what we're doing here is we got 3 legs on this thing. If we come in and look at our orders, we're going to sell one for 79 cents. We're going to buy one for 30. That's not right. Let's do the premium. We're going to sell one for $11. We're going to buy one for $10. So the one that we're buying is going to pay for the one that the one that we're selling for $11 is going to pay for the one that we're buying. And then we're Wait, which one is which? Well, it's easier to see on the screen. Let's go look on the screen. I got too many drawings. Let's get rid of all the, I don't want to get rid of all the drawings. Let's just get rid of the Fibonacci rulers. All right, here we go. So here's what we're doing. We sold one. We sold a put right at the money. And when you sell a put, they give you the money, right? So we're going to receive $79. See that? 79 bucks. But then we bought a call right at the exact same price. So they're going to have to pay $73, right? It's actually a credit spread right there. It's not even a spread. It's just a credit. So we got a credit of 73, 4, 5, 6, 7, 8, 9, $6. All right, so we bought one and we're selling one right at the exact same price. That means that's a free trade. It's called a synthetic long. It's going to act exactly as if we bought the shares, but it's options. So we have the leverage and we don't have to put out as much money, right? Because if we were to buy 100 shares, it'd cost us $11,000. Or what? Yeah. No, 100 shares. It's only $11. 100 shares would be $1,100. So instead of $1,100, the way we're going to do it with options. We're going to do the exact same thing. It's like buying 100 shares, but we only have to pay $100. And then we're going to buy some insurance. Okay, we're going to buy an insurance policy down here. Now, we don't have to buy the insurance policy. If we took the insurance policy off, we wouldn't have to pay that $38, which means we'd make $60. But then you'd, if the market fell, you'd take the losses if you owned the shares. And that's just a synthetic long. Well, you can delete that if you want to. It's like not having a stop loss order in there. And it's going to reduce your margin too. So we're going to put that back on there. We're going to buy the call and we're going to sell a put right at the same price. There you go. Very simple, very easy. Buy a call at the money, sell a put at the money. They're going to give you the money and they're going to charge you the money. So you're going to actually have, in this case, we're going to receive $6. The return on risk, it says, is $1.72%, but that's not true because we're going to look for growth, right? We're going to anticipate that Ford's going to keep going up. The margin requirement on that is $349. $349. So we're buying a call and we're selling a put. The put is going to pay for the call, but then the market's going to rise, so the call will increase in value over the next 113 days. You're not just going to receive $6. That's why it's telling you it's 1.72%, $306 on $349. But we're expecting that call to go up and make money. If it doesn't, you can put an insurance policy down. You can put a stop order in here. But you saw how far the stop was, way down here. So we come in here and we're going to buy a put way down here. Click, way down there. It's $38. So, and then the market would have to fall clear down there to stop your losses. That's a long ways. You could probably just liquidate the position before that call. But what that's going to do for you is it's going to reduce your margin from 349 to 100. And is that worth it to you? Yeah, because you can buy like 10 of them instead of 3 of them. Then you got 10 times the value. So you're going to put this in there, click. Yep, that cost you $38. Now you see that you're going to pay $32. All right, on this margin, because you got to pay the $38.50 for this one when you only make it $6 up there. But for $32 with a margin of $600, you got unlimited profit potential to the upside. Unlimited profit potential to the upside. And all I have to do is pay $32 and I'm controlling 100 shares with unlimited profit potential to the upside with a margin requirement of $100. Hell yeah, I'm going to do that. I'm going to do that all day long. All right. So we're going to come in here. How many are we going to do? We're going to do 10 of them. Now you're going to pay $330. You're going to have a margin requirement of $1,000. You're going to margin you at max loss. So you could lose $1,000, but you got unlimited profit potential to the upside. Unlimited profit potential to the upside. And your max loss is $1,000. And we think this market's going to go all the way up to here. It's going to stay inside that cone. That's our Fibonacci projection. Is it going to do it? No, nobody knows. We don't know what it's going to do. We're just making a wild ass guess, right? This is a swag. That's what we call a swag, a scientific wild ass guess. At least we're being scientific about it, right? We're being scientific about our wild ass guess. We've used all the math that we know. We got all of our math formulas in here. We're right here at a perfect little bow tie. We're at the second drive, going into a third drive. If you don't feel comfortable risking $1,000, just do one. Just risk $100 just to see, learn, right? Or just do it in the demo account, and then you don't have to worry about it. Now, our spread in here is $50. So we're going to have to pay a little bit more in spread because in the demo account, well, it's not much, $80. They don't make you. Now, let's see if we can get it filled. That's the question. We'll put it down one just to make sure. We get filled? Come on, don't not fill me. Come on, fill me. Come on. Why didn't it fill me? We got plenty of volume, plenty of open interest. I mean, this thing should be a no-brainer. This should be a no-brainer. This is no-brainer. No-brainer. No bueno. Come on, fill me. Why isn't it filling my order? Maybe I go the other direction on the spread. Maybe go in the wrong direction on the spread. I don't think so, though. Oh, I was going the wrong direction on the spread. That spread wasn't as wide as I thought it was. What did that end up being? Well, we're down $45. I'm happy with that. For $45, we've got 10 contracts long with unlimited profit potential and $1,000 in margin. Total cost base is $390. Bam! Now that's how you do it. That's how you make money. That's how you make money. We got almost no cost in this thing. Max loss is $1,000. We know our max risk. We know we can't lose any more than $1,000. The max amount of money we can lose. But we got unlimited profit potential to the upside with 10 contracts. 10 contracts. 10 options. That means that's like having 1,000 shares. That's like having 1,000 shares. We just bought ourselves 1,000 shares of Ford Motor Company. Think about that. If we put in 1,000 shares, that would cost us $11,000 if we were to put 1,000 shares in. $11,000, and all we put in is $390. Now, yes, I know if the market doesn't go up, we're going to lose money. But if you put $11,000 in and the market doesn't go up, you lose money too. And we don't have to lose 1,000. I mean, if it doesn't go up, yeah, you get out after you lose $300-$400. You don't $100. How much you want to risk? $200? Get out when it loses $200. I mean, there you go. That is one killer strategy right there. That is one killer strategy. All right, let's go see if there's something else we can put a killer strategy on. Let's see. Let's come back to bubbles. Man, that was a good find. Let's find another one of those. See if we can't find another one of those. You'd think Tesla's one of those, but I'm so pissed off with Tesla. For as lousy as Tesla's doing, I got way too much money in Tesla. CBS. We got to find us another Ford. Pfizer. I don't know if I want to do that with Pfizer. The setup is good. But Pfizer, nobody likes Pfizer. Everybody hates Pfizer right now. It's you got to go look at it. You got to do your homework. You got to go look at it. You can't not do it. You got to go look at it. Doesn't mean you have to put the order in, but you got to go look at it. Well, it's a 3-drive pattern. Okay. So it's already done the 3 drives. Drive 1, drive 2, drive 3. Now we're coming into the ABC retracement. And we're right there at 50%. We're halfway. We've lost 50% of the value. Look at that. Isn't that amazing how this works? It took it from April 9th, 1st of April, to July 10th. April, May, June, 3.5 months to go up. And it lost 50% of the value in 1 month. Markets fall faster than they rise. Just keep that in mind. All right. So 3 drives up, ABC down. We're sitting right at, it's touching right now, just as if a computer was trading it. It's touched 50% and it's pulling back. So if we go in and we look at our 5-minute chart again, it touched 50% right on the numbers. I mean, it came in just like a computer was trading it, because it was, and it touched the number to the penny and turned around and starts going back up again. But it's Pfizer. And this strategy to buy a synthetic long, the market has to go pretty aggressively up. All right, it can't dilly-dally. That's why it's important for you to do your projections, and it needs to stay inside of your projection cone. And that's because, what's your projection cone, Lan? Well, I ain't got one very good. I got a very good one here. And the reason is because we're already fulfilled our 3 drive pattern. So our cone of probability is pretty lackadaisical. So that ends up being kind of the projection right there. See how I did that? I went from the first point all the way to the peak. I went from the second point all the way to the peak. I went from the third point all the way to the peak. And then I went to where it's sitting right now at 50%. If it goes down to 60%, we'll just redraw these and you'll get a new projection. But this is your cone of probability is what we call this, all right? This is your cone of probability. Oh, let's draw that. I have to remember that they changed my tool on me. So there's our projection tool. If this market starts to rally out based on the previous volatility, and that's what that's measuring. It's just measuring the previous volatility of the market, right? So the previous volatility was this. So if it does the same volatility scale, just stays in the same volatility to the next run, it should go up inside that triangle somewhere. All right. And if it takes that same, if you just take that same line, which is basically from here to here, right? Take that same line and you take it and you put it up here, it should go up, basically up that delta cone of probability right there. Now, how did you do that, Lan? It's in my book. It's in my book. Your book? I didn't know you had a book. Yeah, if you go out to Amazon and search Lan H. Turner, don't forget to put the H in there. Lan H. Turner, my book will come up. It's like 280 pages, full color, 8.5 by 11. It's a workbook. It's not a book. You don't read it. Well, you can read it at night in bed if you want to, but it's a workbook. You lay it out on the table next to your computer, and it tells you how to do this stuff. All right. Fibonacci cones of probability are in there. It'll teach you how to put this in there, the whole concept, why it's in there, what we do with it, how it works. So it's all in that book, along with all these 3 drive pattern stuff we talk about. Drive 1, drive 2, drive 3. It's got the spider webs all in there. Shows you how to do them. Shows you all the probabilities. It shows you what the probabilities of all this stuff is. So yeah, go get the book. Shows you. I wrote it all down. I wrote it all down for you. You're like, Lan, did you write this down? Yes, I did. It's in a book. I put it in the book. It's $10,000 because that's how much money it's going to make you in the first year. Guaranteed. Just kidding. Past performance not indicative of future results. There are no guarantees in any of this stuff that we're doing. All right, so that's what we're looking for. So the problem with this is that it's on the third drive. So usually what happens when it comes down and it does this is we end up with a narrow sideways channel right in here on that third drive as it starts going through the reaccumulation stage. All right, so it's got to go through a reaccumulation stage. So we'll watch the chalk and money flow on this Pfizer chart. And watch this market maybe be a little bit stupid in here. Maybe give us, 3 times a charm. We at least need to have the blue lights come down and intercept. Where that's going to happen, they're pretty high up here still. So the market's going to either continue down a little bit here, bringing this down to the 61.8 level, or if it does rebound off of 50%, it'll probably wander a little bit in here, and then we'll probably get a cone of probability out here. I want to wait until we get a little bit more of a confirmation. So let's delete all this stuff and just draw a simple trend line. All right, just like that. Now, we may get another little point in here, a little point like this, and then another little fall. We don't know. We're just speculating, right? That's why we call ourselves speculators. And we might get a new trend line that brings us like this, right? We don't know. We're going to look for a bottoming pattern in here. We're going to try and figure out where that's at. We can make our Fibonacci projections, and that's why we do that, right? Well, we think it might come down into the Fibonacci sweet spot. Well, it has. It's dead center of the Fibonacci sweet spot right now, but it's still on the way down. So we got 61.8 down here. It might come down a couple more bars and get to 61.8. If it does that, then if we can get, that would be a good place. Then we could do the Ford trick. We're putting the Ford trick on early. But realize that, all right? Realize that the Ford trick is coming on a little early because Ford didn't come back to the 50%. Well, it did. That's exactly 50% of the whole run. Oh, it's 38.2 right there. So we're just a tiny bit early on Ford, but we have a lot of confidence that Ford is going to go up anyway. So we don't mind, because if this comes down and hits the 50% on the overall longer term rate, or even down to 61.8, we could just add on some more. And we've got 115 days, 113 days. Now, we would like to see it turn right here. Probably not going to, but it hit 61.8. It might do a little bit of it. We got to wait for that. I mean, you just think about it. You've got this natural trend line coming in here, and it's got to cross that. It's got to bounce a little bit, get a little head and shoulders formation in there. It's okay. This is a little rushy, but that's because we're in class and we're seeing it. We got to show you how to do it. But you can be a little bit more cautious and wait. You got your left shoulder here, your neckline, your head happens to be right here. You get a little neckline in here, a little pullback. It might be back down in here, and then it'll take off. All right. We don't know. We just know it hasn't crossed the blue lights yet. We got a natural trend line in there. We know it's moving in ABC patterns. So keep that in mind with your Ford. I mean, we put this on here because we're a little bit excited because it hit 61.8, but that doesn't mean it's going to turn around and shoot up like a rocket ship right now. Could, but going into that third drive, but the third drive could round out a little bit here too, which is what we're looking at with Pfizer. All right. Pfizer might round out a little bit here. This is already the third drive pattern. That's why. So generally, once you go through the full 3 drives, we get more of an accumulation stage here. So this indicator right here will turn and go green for a little while, kind of like this. All right. So just look back and say, well, where's it at? Well, it looks like this. So we might get one of these. Right? Might get one of these right here. And that's what we're looking for. Once that happens, and then we get that little confirmation that the market looks like it's getting ready to go, we can put one of these synthetic longs on. We're not ready to do it right now. Still on the down low. So you got to do your math. You got to do your work. All right. I know it's just work. Uh-oh, you know what? I gotta take off. I got an appointment in 30 minutes. I got to be to. So we're running out of juice here. We started off a little tough, but we're ending strong. All right, guys. So we had a good lesson today. That synthetic long is a really nice strategy. I know most of you probably already know it because I taught it before, but it's a good one. Look at that Ford Ford and Pfizer just happen to be the ones that are just, oh, Apple. What about Apple? We've already got a long position on Apple. We got a covered call on Apple. Well, okay, one more. I got to go though. I got to run. AAPL. I got to run. All right. Oh, 3 drive Apple. Drive 1, drive 2, drive 3 failure. C1 fail. Where's it going to come to? Oh, doggone it. Oh, we were looking for one more drive on Apple and it didn't happen. It's probably going to come all the way down to 38.2. It's going to probably come all the way down into the Fibonacci sweet spot. Just keep if you got your long call in there, just keep putting covered calls on it and just keep helping reduce the loss. Put your covered calls in there. You'll be okay. But we were looking for Apple to break out of here and give us one more drive. We thought we'd get a drive, pull back, drive. No, Apple failed. Apple is a failure. You guys all know I hate Apple. I like my little iPhone. I just hate them as a company. All right, guys. That's all I got for you today. Okay, at least we ended strong. All right, we started weak. We ended strong. Just real quick here.
Okay, this is the software I use. It's called Track and Trade. They've got 2 versions, one for stocks, one for futures. This is the website, track, the letter N, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, that's how it works. And if you like this little synthetic long strategy that I'm showing you here on Ford Motor Company, if you think that's a pretty neat little strategy, give me a thumbs up. All right, it's always nice to have a thumbs up. Say, hey, Lan, that was a neat little strategy you put on there in Ford. I like that. Thumbs up. All right. And then, of course, we're going to document that, and it's going to be in Pitt News Magazine. In Pitt News Magazine, we're going to have that strategy right there will be documented in Pitt News Magazine. So it'll be all written down for you, give you examples, talk about it, show you how it works. The whole works will be in Pitt News Magazine. Pitt News Magazine, what's that? I don't even know what that is.
Look, if you haven't subscribed to Pitt News Magazine yet, then I'm going to need to see you professionally because you must have something wrong with your brain.
Yeah, go get Pitt News Magazine. Where do I get Pitt News Magazine, Lan?
Ready to level up your news game? Welcome to Pitt News Magazine, where stories come alive. Read it, hear it, or watch it in our YouTube classroom. Right now, get your first 2 issues for just $1. Yep, only $1. Don't love it? Cancel anytime before the $39 yearly fee kicks in. Try it out, risk-free. Satisfaction guaranteed, or your money back. Visit pittnews.com. That's pitnews.com. Pitt News Magazine. News your way.
All right, news your way. All right, guys, that's all I got. I got to run. So we will see you bright and early Tuesday morning, 8 a.m. We'll do it again.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.